The 4% rules talked about like gospel in the financial retirement planning world. But let's be honest, it's always been more of a rough guess than a golden rule. But today, the original creator of the 4% rule is revising it to 4.7. So let's take a look and see why he's doing that and a little bit deeper dive into the actual 4% rule itself. Let me grab Walt and we'll take a look.
It's another episode of Power Your Retirement. I'm Walter Storholt alongside Steve Smith, certified financial planner, and we're breaking down a good one on today's episode. We're going to be talking about the 4% rule. It's getting a makeover. Breaking news in retirement planning, it's now the 4.7% rule, according to the original creator. It doesn't have quite the same ring to it, though, does it, Steve?
It really doesn't. I mean, couldn't they just round it to 5?
Right. I guess it would be inaccurate if we did that, right?
or play with the play with the stock bond ratio. Because
do something to just round that up a little bit. Yeah. Well, today's episode, we're going to see if this makeover means more income for you. Did you just get a raise in retirement by now having this higher withdrawal rate? We'll talk about the original 4% rule, what it means with these changes, and then just more generally, like, what does this all mean for your potential retirement? So we're going to dive into all that on today's episode. But Steve, let's talk about the basics first before we break down everything in the article and the changes, but which, by the way, we'll link to the article in the description of today's show. But what was the original 4% rule all about?
So everyone wants to know what their number is, right? Is it $1 million? Is it 2? Is it 500,000? What is their number? And then once they know their number, how much can I take off of that? So the 4% rule really tickles the ears a lot because it gives the layperson that might have a 401k a format. Like a target date fund has an investment theory to it. The 4% rule has a distribution theory to it.
I was just going to say our previous episode of the podcast, which we can link to in the description of today's show if you want to go check that out, all about target date funds. And you're right, that's kind of this like the easy button for those who don't want to think too much about their retirement plans on the front end. I guess the 4% rule is kind of that easy button on the back end. It's sort of this very distilled down version of what you can do in your retirement years.
Definitely. And while I love rules of thumb, if you will, or golden rules or even just suggestions, really solid theory-based suggestions, if you think about what you do, and a lot of my clients work for utilities, but can you imagine if they went to a class and watched some YouTube videos and then just went out to go climb a pole and did their thing? It probably wouldn't work out super great. There'll be a few that are, pretty good visual learners, off of there that would figure it out. But there'll be some tragedies along the way, I'm sure of it. So that's what these rules. Well, rules are made to be broken, isn't that what we all learned in elementary school, or maybe yours, but definitely mine.
We'll definitely break a little bit of rules on today's show, I think. So it was William Bengen in the 1990s when he first set up this 4% rule. And he's saying, okay, over 30 years, you can withdraw 4% from your retirement plan without running out of money. You should be okay to do that. It's considered a safe withdrawal rate, even under bad or worst case scenarios. Well, it's been the 4% rule for a long time, and now it's got the update to the 4.7% rule in 2025. So why the update and what tweaks has Bengen made?
So he's done a couple. He's played with the numbers a little bit. So the 4.7 rule, he changed the asset allocation to 55-45. So he's bumped
a little
up
more stock.
He's bumped up, a little less stock and a little bit more bond.
Okay.
So he's bumped up the bond a little bit, which we're getting better rates than we were, 10 years ago, 15, 20 years ago. We were in that 2 to 3%. So we're getting better returns on our bonds, which makes it a little easier to bump that from 4 to 4.7. We've also had a really great run over the last, 10, 15 years in stocks as well. So it gives him more confidence. But that, and also with the 4.7% or the 4% rule, that's assuming diversified portfolios, regular rebalancing, and all those long-term retirement timeframes that come along with this. But just know, when I was kind of opining on some of the things he changed, he's just adjusting for today's data. And tomorrow's data may not be today's. So as 4% maybe doesn't apply now or never did, or whatever the case may be, what happens next month, next year may not be. So that's part of the problem with these rough guesses or rules of thumb, is that it doesn't necessarily apply to you.
Yeah, they were clear in the article by saying, hey, that this is not a green light to go and spend more. The increase isn't this blanket permission slip. A lot of this is still going to depend on returns. It's very theoretical.
Right.
So, and it's still based on historical, back testing. It seems like an industry buzzword, but it's like those disclaimers. Past performance doesn't indicate future results. They've tended to throw a lot of that into this report and into these new findings as well. So I wanted to zoom out with kind of taking all of this into account and looking at maybe this new landscape and the increase from 4 to 4.7. Let's look at some of the popular questions that a hopeful retiree might be asking, and what they should be thinking about in response to this bump up in the 4% rule. So if a client comes across and reads this article, one thing they may think right off the bat is, should I adjust my strategy? Should I redo my income strategy now that this 4.7% rule has come out? What do you think about somebody who might approach you with that question?
So if they were approaching me, I would say, let's not rush into anything. Let's make sure that we look at where we're at, how long you're going to live, when you're going to retire, if you're already in retirement, all of those things. We want to make sure we look at their personal situation. But for someone that's maybe in a target date fund that's not getting any advice right now, it's possible that they could. But then again, they're taking risks of 4.7 just like they were at 4.0 in the target date fund. So you want, if you throw caution to the wind and go with that, you can, unadvised. But if they're coming to me, I would say, let's dig into the real numbers, what you have, your spending patterns, what are your goals, what do you want to buy, all these things, what do you want to give, those types of things are much better, because a higher withdrawal rate, while it may sound good, running out of money and asking your children for money doesn't sound very good. So we want to definitely make wise decisions based on your personal circumstances, not based on what you read in a magazine that was written to millions.
Yeah, it's definitely not plan A or B, right?
Yeah.
So if somebody retired recently or was planning for their retirement and kind of, you mentioned it at the beginning of the show, sort of this 4% rule as gospel, are they now thinking, oh my gosh, does this mean the 4% rule was wrong? How do you respond to that?
So maybe it was wrong. Maybe it was right. Maybe the 4.7 is wrong. Maybe it's right. And I would say that it's probably wrong more than it's right, because it's general in nature. And just like a clock, it's right twice a day, even if it's broken, right? So it's a general rule. It's an average. And if you take a look at test scores, or you plot anything, if you took statistics in school, you always have that average, or whatever the criteria was. But most people aren't exactly on that average. Most people are scattered in on both sides of that. And the reason why I say that is because your personal situation is what's going to skew you on both sides of that average. And that's why it's so important to have your own personal retirement plan. Not that we want to put down or lift up this 4%. It's just somebody wanting to write something on averages according to the data as of today. That's all that it really is. And it doesn't necessarily apply to your personal situation.
As with many rules, it can provide a nice starting point, but ultimately we're going to end up somewhere else. And I think that opens up an interesting question as well. Like we don't have to have all the focus on the withdrawal rate. What other factors matter even more than the percentage I'm trying to withdraw? There's all sorts of other little moving parts that when you're doing this more sophisticated planning that you're able to get into with clients.
So one, you might want to pull this up on Gemini or ChatGPT if you're listening out there, but the sequence of returns is probably one of the things that's never talked about. That is one of the most important reasons why you want to plan, especially for that first 10 years of retirement, because if you go into retirement in a prolonged down market, we call it bear markets, that can have a devastating effect on a retirement plan if you don't have contingencies and different things played out. And that has nothing to do with an average. So the sequence of returns is something that I will always look at, and in the big data behind the scenes, to make sure that a client can have that 30, 40-year retirement without running out of money. So that's one of the things that all these rule of thumbs and guides, while you might have a normal first 10 years, or you might have a high return 10 years, well, sure, then it's all going to work out. But what about that segment that doesn't? And my job is to make sure that everyone wins, or at least has the best outcome possible that I can do with my expertise, and not just wing it on an article in Forbes or whatever magazine it came from.
Yeah. I think this is leads us to the last great question somebody might be asking. And if you're asking this question, I think you're starting to ask the right question. And that's, okay, the 4% rule is a starting point. It's a rule of thumb. It's general. It may be based on averages. And whether that's the 4% rule, the 4.7, or our rounded up version of the 5% rule, what's my personal safe withdrawal rate? That's really the question we want to get people toward, right?
Yes, and that has to do with lifestyle. It has to do with how successful you've been by paying debt down. How much are you dragging into retirement of debt? Maybe that's a mortgage, or maybe it's an RV, or whatever it is. It also depends on how much fixed income do you have. Do you have a pension, a traditional pension? Do you have a cash balance pension? Do you have, all these other things do you have an inheritance that you received a little earlier in life? So all these other things, really, how healthy are you, depend on how we actually structure that. So I would encourage all of you to go find a financial advisor, reach out to me, and start planning while you're still working, so that you can have that guide, take into account all the things that could go wrong. So you have an alternate plan if that does happen to you, and really have confidence moving forward, as opposed to hoping that the articles were right and the rule of thumbs were right.
For one person, it might be the 3% rule is plenty for you. And for the next person, you might need the 7% rule in order to accomplish your goals in retirement. And that's the beauty of it, is that you can get that customized and personal guidance when you work with an advisor like Steve Smith and the team at Powerhouse Financial Advisors. If you'd like to get in touch, what's the best way for me to start? How can I find out more? What else does Steve do? The best place to do is go to powerupyour401k.com. powerupyour401k.com. At the website, you can order a free retirement toolkit. That is going to have Steve's book in it, along with other helpful resources as well. And it's going to walk you through lots of different ways that you can engage and interact with Steve, and ultimately become a client, or at least have an initial visit, right, Steve, where they can find out if they'd be a good fit to work with you and what kind of difference you might be able to make in their portfolio and long-term in their retirement plan.
Absolutely. And the takeaway from today is that hope is not a strategy. Panic is not a strategy. What we do is we want to base a plan for your retirement based on the facts of your life and your situation to have the best outcomes we can. So I appreciate y'all listening. Thanks, Walt.
Thanks so much. We'll see everybody next time right back here on Power Your Retirement. This podcast is provided by Powerhouse Financial Advisors, an independent firm with advisory services offered through Parson X Advisory Services, Inc., PAS, a federally registered investment advisor. The information provided is for informational and educational purposes only and should not be considered as personalized investment advice. PAS does not guarantee the accuracy, completeness, or suitability of this information for your specific circumstances. Investment decisions should be based on an individual's goals, time horizon, and risk tolerance. Past performance is not indicative of future results, and all investments carry a degree of risk, including the potential loss of principal. Any case studies, testimonials, or endorsements shared in this podcast are illustrative of individual experiences and may not be representative of the experience of all clients. They do not guarantee future performance or success. You should not infer any level of assurance regarding future financial outcomes. Listeners should consult with a qualified financial, tax, or legal professional before making any investment decisions. Parson X Advisory Services, Inc. does not provide tax or legal advice. Be sure to consult with your tax and legal professionals regarding your specific circumstances. For a copy of our Form ADV Part 2A, which provides additional information about PAS, including our advisory fees and services, please visit powerhousefinancialadvisors.com.